everybody. Welcome to the 21 Hats conversation. I'm your host, Lauren Feldman. My guest today is Brent Beshore, who has a $300 million private equity fund he uses to buy and partner with small businesses. But he says he's really more of an anti-PE guy. In fact, his firm is called Permanent Equity. Hello, Brent. Thank you for joining us today.
Hey, thanks a lot. I'm not anti-PE, just to be clear. I have a lot of good friends in PE. We just do things a little bit differently.
I didn't mean that to suggest that you're against PE. I meant you sort of do the opposite in some ways.
We do things quite differently, correct?
Yes, and we're going to talk about that. But first, I want to make sure our listeners get something tangible to take home from this. And as anyone who follows you on Twitter knows, you're at least as passionate about cooking meat as you are about building businesses. So I got to start by asking you, what have you learned about cooking brisket? What's the most important thing?
Gosh. It's fantastic. I've actually only recently gotten into it. I've been a longtime grill guy and had a couple buddies who got into smoking, and I didn't think it was that big of a deal. Like, what's the difference? And then I went over to one of their houses and had a piece of meat they smoked instead of just straight up grilled, and it changed my world. And so I got into it. Yeah, brisket. So it's the most difficult of all the meats to do. Typically low and slow is how you want to do it. And I've been tinkering with the recipe. I actually did a brisket for the Super Bowl. Go Chiefs. Unfortunately, it didn't work out the way that had planned it to. But started at, let's see, I started at 8:30 at night.
How was the brisket? Did the brisket work out?
Phenomenal. Yeah, I started at 8:30 the night before and had it run all night, and got up about 4:30 in the morning and wrapped it up in butcher paper and put it back on, and then took it off about 11:30 in the morning, and then put it in a cooler and let it rest until game time. It was fantastic. So yeah.
Did it make up for the game?
Yeah, barely. I don't want to talk about it.
All right, let's talk business then. The traditional PE firm business model has worked very well, at least for PE firms. Why mess with that model? Why did you go in a different direction? How did that happen?
Yeah, I mean, so look, I've never taken a finance class in my life. I don't come from a pedigree background in a private equity shop. I joke that I'm the Forrest Gump of private equity for a reason. I sort of fell backwards. I drove the clown car into the gold mine, whatever analogy you want to use. It started from just first principles thinking, right? And the first principles were, I was an entrepreneur. And so I can relate to what operators feel in day-to-day pulls of business. I understood that having a ton of debt put on the business through sort of a sale of the operating business would create stresses on cash flow. It would restrict decision making. Having a short time horizon in which you had to do something with the business would necessarily create sort of poor longer-term decision making. I mean, there's just no way to make good long-term decisions with
short-term time horizon. You're referring to as PE firms generally are looking at 7 years, something like that.
Yeah. And I mean, if you think about it, so maybe the duration is 7 years, maybe up to 10 years, but I mean, by the time you're not going to catch it as the first investment probably. And then of course, you need to leave some leeway on the back end. So this is where, a normal operating practice for PE firms is to really understand and look for who's going to buy the business even before they sell it, or who's going to buy the business before they buy it, right, from them. And so it really creates like kind of a 3 to 5 year time horizon. I mean, potentially even shorter than that. And so anything that you're going to do to reinvest back in the business that's not going to be felt and felt pretty strongly within that short time period is probably not going to fly. And there's a lot of decisions that, I mean, we ask our operators all the time, what are things we can invest in today that would set us up for the future, right? And the future is going to be longer than 5 years. Gosh, we hope so. And so, yeah, I mean, there's a lot of things that I think it was just first principles thinking that led us down this path of, okay, what do we need? We need long-term capital. We don't want to be using a lot of debt. We have a humility about us. Everyone on our team is operators, has come from an operating background. And so we all understand how difficult it is to run these businesses. And so we don't come in and think that we know, how to operate these businesses. I mean, this is somebody's life work. They are an artisan. This is what they do for a living. We may know some things about the everything tastes like chicken layer of business, right? The sort of the business of business. But I would say we try to have extreme humility and come in and partner with teams that are already in place and not come in, inject our own people, try to change everything. We try for progress to be slow over time. And so A lot of those things is just the opposite of how traditional private equity works, right? And not all private equity is this way. And I don't want to sort of paint it with a very broad brush, but the sort
Definitely
of
true.
barbarians at the gate style of private equity is, I joke it's the buy, lever, strip, and flip model, right? And it's just the opposite of how we like to do business. And we just think life is going to go a lot better for everyone personally and professionally if you don't have those types of pressures.
Of course, things like those time horizons exist for a reason. It's not a random. I think a large part of it is private equity firms take investment money and they've got to return that money, and people want it in a certain amount of time. Does that mean you're going after a different type of investor? How do you manage to work to raise the money you raise without promising that?
Yeah. So we had a lot of conversations, got laughed out of a lot of rooms, I would say. I think that what you put out there, you attract. And so we repel a lot of people through our writings and through doing things like this that just wouldn't be a good fit for us. There's a lot of people who, one very specifically sticks out in my head, who said 27 years, that's crazy. I'll be dead. You'll be on your third wife. You'll have vacation homes you travel back and forth to. Your kids will hate you. And who knows if you'll even still be there. And I was like, that seems like an oddly specific example to use, but uh, thanks. And so he's like, no, I'm not going to invest. Heck no. Right. And so, look, we found a group of families and some institutions that believe deeply in the first principles that we espouse, right? Believe deeply that you need to be able to have long-term capital, make good long-term decisions, that in the end, being able to let things compound is an incredible source of returns, and that they want to see a better model in the marketplace. And so, for us, like, I just think it's about keeping things simple. And I think life is complicated. People are messy. I'm messy. You're messy. When you get messy people together, messes happen, right? It's a heck of a lot harder when that messiness interacts with, high leverage situations or short-termism. And so what we try to do is just be thoughtful around how do we set the table the best so that we can create positive outcomes for not just us, of course, our investors, the executive leadership teams of these companies, but also the employees, the communities that we're in, the vendors, and of course our customers, right? So there's a lot of stakeholders that don't have to do with the immediate interactions between the LP and GP group, that I think really matter. And ultimately, if those people are all satisfied or happy, hopefully, then it'll produce above average returns. I mean, if you look at most private equity firms, I mean, you talk to somebody and say, "What's the best investment you ever made?" That's one of my favorite things to actually ask private equity guys. What's the best investment you've ever made? And they'll tell you a story about its incredible, return. And you say, "Okay, how long did you hold that investment?" And they'll say, "Oh, 3 years, 4 years. We had to sell it because we had to raise the next fund." And you say, "Gosh, did the next guy make a lot of money off that investment?" "Oh, my goodness, I'll tell you what. We knew when we were selling that thing that whoever bought it was going to make a ton of money, but we had to sell it because we had to, put up our returns and raise the next fund." I mean, for us, we want it to be the exact opposite of that. Things that we know are compounding and have a huge runway, just let them do their thing.
So let's talk about the types of businesses that you look to invest in. I know you like to say boring is beautiful. What do you mean by that? By the
Yeah, well, it's a little bit.
before you answer that,
Yeah.
I just want to say to our attendees, I'm going to be keeping my eye on the chat box. We welcome your questions. Please feel free to start throwing them in there. Looks like we got one in the Q&A. Yeah, we do. We will get to as many of those as we can. But go ahead, Brent. Tell me why is boring beautiful?
Yeah, it's a good question. So we say it tongue in cheek. Look, a business is never boring, especially to the people working in it, who rely upon it, to the owners, to any of the stakeholders, right? So when we say boring business, the joke is the next line is it's boring because typically all they do is just make money. We're not in businesses that are sort of fly by night, huge run ups, likely leading to huge crashes. Sort of the latest fad. We want to invest in things that are going to be durable and around for a really long time and solve an enduring need out there in the marketplace. So, we're invested in glass and glazing industry. Like, we think that glass has been used for a while and probably will be used for a while into the future in building things. We invested in the swimming pool business. We think people have been dipping their bodies in water for pleasure for a while, and will probably continue to do so in the future. And if they do, we'll be fine, right? We want to be, in a position where, Technology we embrace. We're not going to be the first movers on it. Of course, we're using technology right now. We're using technology all the time. It doesn't necessarily have to be a technology business for technology to, positively or negatively impact the business. And we just want to be in businesses that are changing maybe slower than others, while still being mindful of the fast pace that we can go in some of these businesses to help affect change. Yeah, so I don't know if that answered your question or not.
I think it does. Uh, give me a little bit more description of the type of business you're looking for. Do you care what industry it is? What size are you looking for? Are you looking for um, a level of profit?
Yeah.
Are you looking for a business that is already performing well, or one that you see can be you could help?
Yeah. So right now, so we don't do turnarounds. So all the businesses that we get involved with are successful. What I would say is that the type of business that we really like are businesses that are either right on the edge of or recently gone through professionalization. So when I say professionalization, there's no business that's smaller that's going to sort of check every box of professionalization, right? Across marketing and sales and technology and accounting and governance and finance and all those different aspects, right? What we mean is that there are steps to diversify relationships, diversify skill set, to create redundancies, and to create an operating system in the company that moves beyond a small group of people or potentially even one person, right? So it's the kind of the difference between a hustle and a business. We like to find businesses that are kind of right on that edge, and then we can really help them perform much better through just some things, like I said, the business of business that we've gotten used to and that we know. So typically those businesses are starting to professionalize around $2-ish million in earnings. That's kind of a common level, maybe a little bit below there. We typically like to catch them around $2.5 to $3 million, kind of on the low end, and we'll go as high as 12, 15 million in earnings. So kind of 2.5, 3-ish up to 12, 15 million in earnings. Our sweet spot is kind of $3 to $8 million in earnings. We really like that space. These are hefty organizations, but they're not so big that they are becoming bureaucratic, right? I think you tip into another set of issues when you sort of get into more bureaucracy-driven organizations. And I think there's a real sweet spot in between that you can affect a lot of change and you can move swiftly with a lot of value creation without both having sort of the downside go to zero risk and or the upside in there to be able to really affect those things that can matter. In terms of industries, we're really agnostic. I mean, our philosophy around industries is that there are little niches everywhere that you can get into that are protected for one reason or another. Every every business, even the most sexy businesses, typically have the nuts and bolts organizations that help support them. And so, the kind of the example I've used in the past is you don't want to own necessarily a winery. You want to own the people who make the bottles and the caps and the corks and maybe the distributor, whatever it be that has some sort of moat in that space.
Gotcha. Um, we've got some questions coming in. Let's start with are there could you say there are name three important characteristics you look at for a business owner that you want to invest in?
Yeah, it's a great question. So, I mean, I would say the level of care that they have towards their employees and towards the customers and vendors is something that we take very seriously. So, if somebody really just is trying to wring as much money out of the company, kind of treats people as disposable, it's going to create, just a rot in the middle of the organization that we don't want to deal with, nor do we think it creates a durability over time. So I'd say, we really just try to get to know the motivations of the owners. We're all conflicted. We're not looking for, Mother Teresa to run the company at all. What we're trying to do is really understand, what is the motivations of why the person built the company or owns the company, and sort of how does that manifest in day-to-day decision making. So that'd be kind of one. Attributes. We like to see people who have a low enough ego and enough self-awareness that they realize what they're good at and they're not good at, and are trying, maybe they're not successful, but trying to, or at least open to diversifying their relationships, skill sets, and sort of, like I said, building an organization. this may seem like an obvious thing, but I mean, we looked at a business recently that was doing close to $15 million of earnings. And really it was two brothers. I mean, there was just two of them and they did everything. And sort of everyone else was at their beck and call. And I mean, these guys were amazing. They were incredibly hardworking, actually very kind, incredibly intelligent. But that's just a big hustle, right? These guys are making a ton of money, but they're really doing it. If either of them get hit by a bus, and certainly, God forbid, both of them, that business would go to zero within 6 months. So, I would say just, again, a desire to build a stable, enduring organization. Let's see, a third attribute. I mean, this may sound like an obvious one, but somebody who's enthusiastic about doing a deal. We oftentimes will have conversations with people who seem to be quote unquote testing the waters, and really they're not serious about getting a deal done. Deals are really hard. Any transaction is going to be, it's gonna be brutal. I mean, there are roughly 400 decisions that you have to, agree on, come to terms on. Of course, some are more important than others. Most people just think it's like price and maybe the very high level terms. It's not. There's a lot of moving parts and pieces to it. And so, if you're not enthusiastic about moving forward with an opportunity on both sides, there's just no way you're going to have the energy to get across the finish line. So we've spent a lot of time in the past flirting with people, I would say. We thought we were serious. It turns out they were just flirting. And we spent a lot of time and money on trying to make it work, only to find out that, well, in reality, they were really that serious about selling. So.
How do you explain that? What was were they flirting because they just wanted a sense of what their business was worth to someone like you? Or is it more about the reluctance to bring in an investor and maybe concern about what they've heard about what can happen to a business that does bring in investors?
No, I mean, I think everyone's going to be different. And I always try to assume the best about people and their motivations. I mean, I think, look, the decision to sell your business is not a small one. And I'm not going to sit there and say that it's an easy one. And once you decide, it's, sort of a one-time decision and you move on. Oftentimes, I mean, there's things that come up in due diligence that they didn't even know about, right? They feel like they need to go solve. There's gonna be other times where, look, somebody just really enjoys the attention of somebody kind of courting them, right? And that's something that, is sort of a false negative signal for us. Other times somebody changes their mind midway. They have conversations. They think that everyone's on the same page in their family. And then they talk to their son or daughter and they say, hey, this is what we're planning on doing. And they say, well, no, I was planning on working for a couple of years for, whatever the firm I'm at. And I was going to come back home and run the family business. Right. So there's a lot of these things. It's a highly emotional decision. And look, a lot of the net worth of the family is usually on the line. So the pressure's high, emotions are running high. And I don't fault them. I mean, you need to be able to be confident. I mean, you certainly don't want seller's remorse, post close. So I think there's a lot of different factors. And I mean, look, we just try to be patient and kind. And when people say, hey, look, I changed my mind, we say, great, we'll stay in touch and no problem at all.
What's your preference? Do you prefer to buy the whole business, have a controlling stake? Will you take a minority position?
Yeah, so we have historically not in the past taken minorities. So they're all majority positions, but we prefer not to buy 100%. So we're not trying to get rich fast. We're not trying to squeeze every dollar out of every opportunity we get involved in. We'd rather partner with people. We'd rather win together. And so our ideal acquisition range is kind of 60 to 85%, depending on the situation. We have bought 100%, but it was in very specific situations where the seller, there's really, it didn't make sense for us not to buy 100%, but I would say that we default to partnership over time. Yeah, let's see. What was the other part of your question? I forgot. Was that it?
I think that's it.
I think that's it. Okay, good. All right.
Yeah, I think you covered it. We have one person looking for a clarification. When you were referring to earnings before, you were referring to net income, correct?
Yeah, we call it owner earnings, which is basically kind of an adjustment. So it's EBITDA is so earnings before interest, taxes, depreciation, and amortization, sort of minus a normalized capital expenditure, right, to keep the business on a good plane. So it kind of normalizes out business models. Some business models are incredibly capital intensive, and you need to be constantly reinvesting in them to sort of tread water. So EBITDA can kind of be all over the place, as well as net income can be all over the place because you have some businesses are taking huge depreciation for some reason that maybe is not normalized or is growth capex based or something like that. We try to normalize for owner compensation. So this can vary pretty wildly depending on, we've seen owners who are taking $2 million salaries. We've seen owners who are taking nothing out of the business. Both of those are typically wrong. So we're trying to normalize for that. And really just trying to get an idea of, after all the reasonable reinvestments are made, what is the discretionary cash flow left over for the owner to either go buy a boat or to reinvest in growth or to do whatever they want to do with that. That's kind of the number that we're really trying to get to.
Do you pay as close attention to total revenue?
Revenue matters in the sense that it is, it is a measure of heft. Although, again, it varies by business model, right? You can have a business earning, $3 or $4 million a year on $10 million of revenue if it's a service-based company, high gross profit margin. And you can have a distribution business that is doing $200 million of revenue that's making $3 or $4 million, right? So it just really depends on the business model. So I think that what I would say is every piece is a piece of the puzzle. And what we're trying to do is we're trying to tell a cohesive story based on what we understand from the numbers, as well as what we get from the sort of the narrative from the leadership team, and really trying to piece it all together. You're never going to get a perfect view of what reality is. But oftentimes the numbers probably don't tell you everything, and the narrative kind of may miss from the numbers. And so you're kind of trying to put those things together and smooth out any rough spots kind of in between.
Got it. We've been asked if you could give a quick overview of how you see traditional private equity working, particularly from the standpoint of how much money gets spent and what types of businesses they tend to invest in.
Yeah, so traditional private equity. So again, there's lots of different flavors, and so I'm gonna try to, maybe I'll give a kind of a little bit of the view of the market in general. So if you look at the sort of the mega ones, these are the Carlyles, the KKRs, right? These are the mega sort of bulge back bracket private equity firms. So in essence, I think this is a fair assessment. There's the value add on that level is really their ability to acquire cheaper debt. So if you look, it's almost no business that a Carlyle or KKR is buying is based on a relationship. There's no proprietary deal flow when you're talking about multiple billion-dollar deals. So everyone's going to know about the deal, and there's going to be fierce competition from peers to buy it. And really, the relationships are all based on who can get more favorable access to debt, and the goal is to use as much debt as possible to drive up equity returns. So if you look at the historical returns of sort of bulge bracket private equity, it is very, very close to a levering of large cap equities, or at least mid cap equities. And so, you take the returns that are sort of normal for that segment of the market, whether it's public or private, you apply leverage against it, you're going to make the equity look better over time. And then you sort of back out any interest costs that you had as a result of using debt. And so that's kind of where you get to the returns. So, back in the day, look, when Mitt Romney was in his prime, and I mean, the early days, like you read about the early days of KKR, I mean, they were doing proprietary deals. They were paying 4.5, 5 times for these businesses. They were doing a ton of value add. Like there was a bunch of stuff going on. I think it's trended away towards that. And the market basically just gotten a lot more efficient. If you go down market, there are pockets of specialists. So, I would say is, if you look at like Constellation Software, they've just done a masterful job of understanding what they can pay for these businesses. And they're buying software businesses, small vertical market software businesses, and they're buying them all over the world. And they have a kind of a standard package they're offering. They're willing to move a little bit here and there, but then they're able to fold it in, and they understand operating these vertical market software businesses is really similar across different industries. And so they're high specialists. They understand what they're doing. They understand how to solve problems. Everything's geared around that. I think that's probably the best model of more traditional private equity. Now, Constellation's definitely, they're not using much debt. There's a lot of differences between an example of a Constellation and somebody else in private equity. But I would say the best private equity firms today that are even more of the traditional, again, 2 and 20 fee structure model, more of a 7 to 10 year time horizon, are doing, they're specialists in a type of science-based, private equity, or in healthcare or energy, or, whatever the specialization is. we like to think that we're specialized as well. We're just specializing in a different segment of the market in terms of the style and where a company is, as opposed to stylistically along sort of sector lines.
How do you think about multiples that you pay?
Yeah, I mean, look, it, price is such an interesting thing because the old phrase, you set the price, I set the terms. We oftentimes talk about price without talking about the terms. So it's like in venture capital when you see that the latest VC-backed company just raised at $1 billion valuation, and you're like, what in the world? It's 7 people in a room. How can that be $1 billion company? You often don't see that the amount of capital flowing in is relatively small. You don't understand all the warrants that they would get on the capital, all the preferred returns, all the structure. So when we talk about price, we got to talk about sort of in relationship to terms. What you're typically seeing in our segment of the market right now is multiples sort of between 3.5, maybe 4-ish on the low end, up to 6 or 7 on the high end, right? I mean, that's kind of the range. Now, for somebody that's in the public markets or up market, that sounds very, very attractive, right? I mean, this is where sort of the headline probably tells a different story than the reality, which is, why is that? I mean, efficient market hypothesis would say that, money will flow into wherever it can generate the highest returns. The reason why you have sort of quote unquote lower multiples is because it's really, really difficult to operate in our segment of the market. These companies are smaller. There's a lot more go to zero risk. There's a lot less assets attached to them. And frankly, just the natural flow of talent is going to be different than up market. So you're going to come into a situation which is much thinner from a leadership perspective. You're going to have typically customer concentration. You're going to have a lack of systems, concentrations of knowledge and skill sets and relationships. So all those things sort of bundled together say, the thesis in our segment of the market is that most companies shouldn't be bought. Most companies shouldn't be sold. They're really not a saleable asset. And so really you have to be dragged into doing a deal, and most companies are just not set up for the sale. And so that's where when you get into these, sort of the prices that you pay, it really does reflect the risk that you're taking and the amount of effort post-close. I mean, the idea that in our segment of the market, especially, that you're going to sit back and allocate capital and just, sort of place bets, and those bets will hopefully pay off. Like, that's a fantasy. You're going to have to be, if you get involved in our segment of the market, you're going to have to be very active. And part of being active is, depending on your style, and we learned this the hard way early on, is it creates a dependency among the portfolio companies. The more you do for a company, the more of a dependency it creates. So there's a real art to being able to help improve the companies without creating a dependency and really poor expectations long term. So there's just a lot of, look, there's the hard science behind it, but the math is easy. The math in our segment of the market, you can model a lot of the stuff on the back of a napkin. It doesn't take a genius to figure out, sort of what's going on. You just got to make sure you can post close, you can make stuff happen.
So what's the best investment you ever made? I hear that's a good question to ask.
Well, that's a good question. Probably it depends on how you measure it. If it's a return on capital, if it an IRR, I was fortunate enough. I've known the guys who created Zapier. I knew them. They're all Mizzou guys. So I was an early investor in Zapier, and that's probably the best investment. So ironically, not in my segment of the market, but those guys are incredible.
Well, tell us about your portfolio. First of all, I think you have 9 companies in it. I think you went all of last year, 2020, without buying a business. It seems kind of counterintuitive. You'd think there'd be some low-hanging fruit in a year like that. Why did you not buy any businesses in 2020?
Yeah, so this is maybe a common misconception. So let's go back to the previous kind of cycle. So 2008 to 2011 was basically dead in our area of the market. So if you've got a great business going into a year like 2020 or 2008, you're going to wait it out. You're going to ride it out unless there's some really compelling health issue, some family situation, whatever it be. You're typically going to ride it out, and you're going to focus on how do you maximize the opportunity for your business in sort of a period of rapid change. So the last thing an owner thinks about is, gosh, I got my hands full with all kinds of issues. I'm worried about my family's safety. What I'd like to do is I'd like to start a very laborious and time-intensive and stressful sale process, because I think that would be the thing that's missing from my life right now. Basically, you have a, selection bias against good quality companies, sort of right into the teeth of things. Now that's kind of lightening up a little bit now. We saw a big shift in, I'd call it September, October, where it seems like quality companies now are saying, "Hey, we got through the mess. We feel like we're good footing. We think we want to start a process to bring on a long-term investor. We're gonna kind of move forward with that." The types of companies that we saw, frankly, in the sort of the depths of things, it was all rescues, and we saw some. Man, I saw some stuff. It's just heartbreaking. I mean, I remember there was a period about 6 weeks there where every day, having conversations with owners that were just distraught. Right, their business had gone from being prosperous to being damn near zero, and they were just sort of reaching out to any lifeline that was out there. We actually launched a program called Safe Harbor, which was us being able to take typically probably a debt or convertible debt structure. So it was kind of a rescue financing to help shore up some balance sheets that then would end up long term leading to a long term relationship, a majority recap of some sort. And we launched a program. We got 125 outreaches within the first week. Tons of great conversations, a lot of really interesting companies. And then the government went over the top of us with the PPP and offered a far better deal. And we told everyone, and they agreed that, hey, you should go do that. And if that doesn't solve your problems, then come back. And a lot of it did solve a lot of issues and help save a lot of jobs in the process. So but that was we were trying to be sort of on that wavelength and be helpful during the time.
You weren't in a position to forgive your loans.
Yeah, it's just the government's got a different cost of capital than we do. So.
That makes sense. There's a question we got here. Wow, what industries are you most interested in that are not in your portfolio right now?
I always talk about the same industries. I have just a thing for home services and office services. I think it's the hardest problem to solve. It's probably the most rewarding. It's incredibly sticky if you can do it right. I have very rarely seen it done correctly. And we've been searching for investments in the home services space for a long time. And we just haven't been able to get there. We would love to find a team that we could back that could create, kind of what we call a total solution for the home and the office, which is, it's almost an office or a home as a service. I fantasize about this for me personally. Like, I just want to call one number, whatever happens to my house, I want it to be fixed. I want to be treated fairly. I want it to be done on time. If anybody who's ever tried to have anything, worked on in their home knows that, you call 10 people, you maybe get 3 callbacks. Of the 3 callbacks, you get 1 or 2 guys that show up and maybe one of them even bids. It's brutal. It's absolutely brutal. And so I think there's a lot of professionalization that can be done. I think there's a lot of software integration and technology that can be integrated into these businesses. And so, I would say that's an area that we're really excited about. It's also just a really hard problem to solve, and finding a team that has both the what I would call blue collar chops, as well as the understanding of business and finance to be able to create a scalable organization is just, it's so rare. It is unbelievably rare. Because oftentimes, we've run across a lot of like search funders that have bought, 1 or 2 location, call it HVAC service companies or fireproofing or whatever the thing is. And they just don't understand the actual thing itself, and they're trying to run this business without providing good service. And
What do you mean they don't understand the actual thing itself?
Yeah, I mean, meaning like, if I tried to go in and run a home services company and like, I don't know crap about plumbing, and I'm not going to be able to spend 10 years in actual plumbing to understand with a deep fluency kind of what's going on, right? And so I'm going to make decisions that are going to be poor as the CEO of that business. And there's just really no way around it. So, for us, what we fantasize about is somebody with a deep fluency in the actual thing itself, right? So they're excellent at plumbing, HVAC, whatever the service, whatever it's, lawn care, whatever that type of thing is, but also has the business chops to understand why you would maybe want to scale the business or integrate software. Because oftentimes we've had conversations with people who have a deep fluency in the thing itself, but aren't really knowledgeable of the business of business. Is just, they don't really want to grow. They don't really want to expand. They don't really want to have anything to do with, integrating, new call technology or an application or anything like that, or change their systems or change maybe their incentive compensation structure. Like they have their ways, they're setting them, and it is what it is, right? That's not helpful either, right? So it's sort of like you have to fuse the two together to create a really great opportunity, and it's just really lacking. And so we've never found a team that we felt comfortable with, that we could really go deep in the industry with. But that would certainly be an area that we like a lot.
I'm curious about what you said about the search funders. I think, first of all, we should probably define what that means. Correct me if I'm wrong, but typically that's an MBA who goes out, looks for a business to buy, finds one that is in the position he or she's looking for, and then finds investors to put together a fund and then buy this business and typically operate it, maybe buy other similar businesses, put them together, and eventually sell them. You were expressing some doubt about that. You're suggesting that they may understand the business of business, but maybe not the underlying business. Are you saying you wouldn't invest in a search fund? You wouldn't buy a search fund business?
No, I mean, I think the search fund model itself is actually quite elegant, and I think they can really do really good things. I have not seen somebody with the patience. So typically, you're going to have a Harvard, Stanford MBA, and it's going to be somebody. I mean, look, it's a little bit wider than that, but I'm just talking about the average. Right, it's going to be a highly educated MBA who's really interested primarily in the financial returns, and so we have not seen often as a search fund, even when they execute well on finding a great business, who's willing to develop a deep fluency in the thing itself and sort of stick to it and go with it in, sort of deep in the marketplace. And look, the typical search fund deal suffers from the same short-termism, maybe not quite as bad as traditional private equity, but oftentimes the length of capital is still fairly short. And so, they are incentivized to build a business, get it as big as they possibly can, and then sell it. That's how they, create a realization. And so for us, we've not found a team in that space. We've seen search fund deals that have grown pretty large, and they want to kind of sell it to the next group to realize their gain. And even some in the space that we were talking about here in home and office services, we just haven't seen a team constructed such that we could really partner with them long term. I mean, that's ultimately what we want to do.
I believe I've read that you are eager to buy family run businesses. You talked before about how things can be messy. Family businesses notoriously can be particularly messy. How do you think about that?
Yeah, I mean, look, family relationships are messy. I don't think anybody who's a part of a family doesn't think that. I think that when you combine personal relationship and family relationships with business relationships, it gets challenging, right? I mean, it's gonna be challenging anyway. So I would say we try to come into the best of family situations and really try to understand what the dynamics are and understand how we can be supportive. And look, we've seen some fantastic multi-generational involvement in businesses, third, fourth, fifth generation. And we've seen some where, look, the people everyone acknowledges it's just not possible to kind of pass it on to the next generation. And there's nothing wrong with taking chips off the table, securing the family's future, and potentially, obviously, rolling forward some into the future as well, and helping create sustainability over time. So we just try to. I mean, again, we actually, it's kind of funny. We try oftentimes to talk people out of doing a deal because we really want them to be committed to it when we go into it. And so we'll try to bring up and play, devil's advocate on, what do they really want to sell the business? Is this now the right time? Is there no one else they want to pass this along to? And oftentimes in those conversations, it revolves around family dynamics.
With your 27-year horizon, what happens if the operator you partner with wants out at a certain point? You said you don't want to run the business yourself. You don't want 100%. But if the person you've partnered with doesn't make it through 27 years, what's going to happen then?
Yeah. So, I mean, this is a common, of course, very rarely is the CEO going to be a CEO for 27 years. And in fact, we've recently, I outlined this in our 2020 annual letter, we recently made a shift on this front. Whereas before we really wanted the CEO to be in place, We certainly want the leadership team, whatever that looks like, to have the structure there to carry the business forward. Maybe they're lacking a CFO, maybe they're lacking a CEO, maybe it's a COO, whatever type leadership they're looking for, maybe they're lacking in a piece of it. We like to be most of it intact, but we will go out and find leadership. I mean, we did two leadership changes at the companies this year very successfully, found wonderful people to come in and run them for the foreseeable future. And so we're not scared to go out and recruit talent. We just try to do it in concert with and have it be a very low stress, kind of friendly thing to do. Whereas in traditional private equity, it's almost like the hatchet job, right? Like you're out and we're putting our guy in and that guy's going to drive things forward. We try to be the exact opposite. Just have a conversation that's very open and honest. And say, look, who do you think should be CEO? Okay, if there's no one on staff, which is sometimes the case, what are the attributes you're looking for? Can we go out and find that person together? Will you stick around for long enough to where we can make that transaction or transition, I should say, successful? And that's really what it is. I mean, we just want to have a plan and then go execute on the plan.
Have you had any deals that have really gone bad?
Every deal's gone bad. Yeah, for sure. I mean, literally, that's the interesting part about this segment of the market is there's no way that you can know everything that you should know prior to closing. Hence, you got to have some margin of safety in the price. Every single deal we've ever done, I've had an oh crap moment post close. In which case we've said, okay, I didn't realize that, didn't know that. Now, some of it is just ignorance and me being an idiot, and trying to be, learn over time what pattern matches, we should do. But some of it is just like it's the roll of the dice, right? You're just never quite sure what's there and how things are going to react post close. So yeah, I would say is every deal we plan on things going south. Now, when I say going south, like we had a seller and CEO unfortunately pass away very tragically on us. That's not anybody's fault. Cancer's a bitch, right? Like, I don't know how to say it. It's awful. And, it was a huge blow to the organization. It was a huge blow to our plans. And so we had to accelerate plans that we had in place. We've always got a backup plan for the backup plan. And unfortunately, sometimes you have to use them. We've had people post-close that, they represented their style of leadership and who they were as being very different than the reality that we experienced. And, unfortunately, we had to make changes. We've had customers who have major issues with us that we didn't realize until after close, and we had to go try to fix them. I mean, there's all different kinds of things.
What do you mean by customers? Who are you referring to?
Yeah, I just mean customers of the businesses.
Of the business that you bought.
Yeah, the business we bought that we thought, the largest or maybe the second largest customer, and they, we think that everything's great and, we're delivering, and then post close, it's like, no, we're getting ready to drop you guys unless you make these changes and do these things for us. And we're like, okay, what happened, right? So, it's just really hard to tell with, from the outside looking in until you're in. It's really difficult to tell what's really going on.
So how do you keep track of something like that? What's the ideal relationship you're looking for? How often are you checking in? How hands-on are you?
Yeah, well, I mean, I'm nearing the place where I'm functionally irrelevant here at Permanent Equity. So me personally versus the team, I think is a big discussion. I mean, I am always available. I'm always playing backup. I've seen a lot of stuff, and I have some knowledge that I've built up over the years that I think is valuable in some situations. But we've got a team now that is just top notch, that are far more skilled at the thing they do than I ever was. I'm kind of like the really bad line cook and the really bad pastry chef that turned into the head chef, right? And now we've got like the rock star pastry chef and the rock star, guy on the grill. And so our organization is intimately involved in the companies. I mean, I think in some ways we're more involved than traditional private equity. We try to be helpful. We try not to be pushing services or pushing things. We don't want them to be like, oh gosh, here they are calling again. They're going to harass me, right? I need to produce another report. If anything, we try to be very light on reporting. We try to be very thoughtful in how we engage, and really just try to be always asking, truly, how can we be helpful? We like to be invited in, but when we are invited in, we're not shy about getting our hands dirty. And so it's really across the board, everything from, gutting and redoing marketing systems, advertising campaigns, rebranding companies, new websites, sales incentives, sales recruitment, how are we doing executive recruitment, plugging talent needs, governance issues that come up, accounting issues, reporting. How do we surface data, and how do we surface data faster for better decision making? Technology. How are we using technology, and how can we use it better? I mean, it really is. It runs the gamut, and we've just got a great team that's what they do all day long, every day, and it's awesome.
How's your team structured? Do you assign specific people to each portfolio company, or do you have a marketing team and a finance team that goes across the board, all companies?
Yeah, so I mean, so it's a little bit of both. So we have two people that they're primarily dealing with post close. One is we call the portfolio partner, which is kind of the board of directors in a box. So this is the person who is their day-to-day contact, helping work with strategy, answer any questions they might have, helping to really just move the ball down the field as fast and as smart as we possibly can. Then we've got somebody from the finance team that is interacting with them, and typically their CFO or controller that's in place, interacting between them and getting feedback loops of data and information around the financials and financial reporting, so that the board of directors in a box can focus more on strategy, allowing them to get data and feedback loops there. So those are it's kind of a dual hook-in structure post-close. And then we have a lot of resources on staff that are multi-talented, but can be then resourced through those relationships, whether it's again marketing, advertising, sales, technology, governance, anything like that we would need to do. So they're kind of getting quarterbacked by that portfolio partner, and then utilized over time.
Brent Beshore, thank you so much for taking the time today. This was great, really interesting. I do recommend your annual letter. If anybody's interested, can they get that at permanentequity.com?
Yeah, we've got all our annual letters and a bunch of stuff on there. Lots of me talking. Unfortunately, my condolences. Yeah.
So if anybody wants to know more, that's the place to go.
That is definitely the place to go. Or DM me on Twitter, or find me on LinkedIn or whatever. Yeah, I mean, look, we're accessible, and if I can be helpful to anybody, let me know.
Do you take questions about Brisket?
I am still a newbie, so I will give you my opinion. It's just going to be poorly formed. I've got people though. I've got people that I know. I know people.
Good to know.
A guy on Twitter. It's funny you said a guy on Twitter. He was giving me recommendations, and he's one of these like kind of avatars that I couldn't really tell. And then he sent me a picture of his trophy room from all of his barbecue wins, and I was like, oh, so you're like this is a thing. Like this is a real thing. Yeah, I've won like 16 or 18 barbecue competitions outright. And I'm like, okay, yeah, you may know what you're talking about. So those are the people that you should be asking about, and I can funnel people to them. But Lauren, thank you so much for having me on. I really appreciate it.
This was great. Thank you. Take care. Thanks, everybody. Bye now.